This is something where we're still seeing lockdowns in China, and yet the prices are picking up. Is this indicative of us thinking that, look, these lockdowns aren't going to last, or is this indicative of just the global demand is so strong anyway?
I don't think it's indicative of what's going on in China at all. In fact, the biggest thing that we have seen from China is a change in their refining and products export policy, which took place last year. China has included refining in its energy intensity reduction target for 2025. And that's why they are limiting the amount of products that they are exporting, which is why the market has tightened up. And then what you've seen in the West, we have closed around 3 million barrels per day of refining capacity in the Atlantic basin, mostly, some in Korea, Japan, Australia as well, which has then meant that we are now, even though demand is above 2019 levels, regardless of what's going on in China, like you said, very, very strong demand in the rest of the world, global refining capacity is about 3 million barrels per day lower than 2019. That's what's causing this tension. And this isn't going to go away anytime soon, because we don't think China's policy, even though they have capacity, will change anytime soon to actually give markets the products it requires.
What does that mean for consumers in the United States? I've always thought of us as being fairly independent from all of that, having our own refineries here. But if global prices go up, is that going to affect us too?
Absolutely, because even though U.S. has ample refining capacity, products markets are global. They are priced off Brent crude. And, ultimately, product markets work on trade flows. So if there is a shortage in one part of the world, there will be flows from different parts of the world to address that. And even in the U.S. itself, we have seen so many refinery closures. And I think you really should look at LyondellBasell. They came out and talked about shutting their refinery at the end of 2023. We have record high refinery margins. Even with that, a refinery of that scale is talking about shutting down its capacity. That's really telling. And it's doing so because running a refinery doesn't jive with its ESG mandates. And I think that's the real problem. Even though demand is very strong, individual companies have different targets, and refining tends to be pretty negative when it comes to ESG mandates. I think that's the real struggle. We are going to be in for some real shortages in refinery. Right now, there's maintenance. That's why product prices are so high. Seasonally, as we come out, product prices should come off a little bit, but ultimately, we are constrained, and we're going to be even more constrained going forward if these refineries continue to shut.
The ESG mandates are still driving this. I mean, I'm kind of shocked by that, because the Biden administration has taken a hard turn and has realized that that's probably not the best thing to do when you're trying to fight higher prices for consumers on these levels. Who's driving the ESG mandates at this point?
No, absolutely. But I think there are contradictory signals constantly from the market and shareholders, right? Even governments. In the short run, yes, you're exactly right that governments are saying, look, we do need to support oil and gas. But medium term, they are still talking about, we're going to be 2035, we will be renewables, and not just US, right? Europe's got mandates like that. For a refinery, which is looking at a 15 to 20-year horizon, it needs the investment to work on that kind of a payback period. That's the challenge, because, as an industry, we are very, very poor at predicting demand. We keep underestimating demand, and it keeps coming up stronger. But that's where the issue comes in, because when you're forecasting and government agencies tell you, well, we're not going to need the oil in 20 years' time, it's very difficult to justify that investment. And ultimately, it's public pressure, right? Shareholder pressure is still very much there in the ESG space.
Shepard Smith here. Thanks for watching CNBC on YouTube.